Good afternoon or good morning, depending on where you are in the country. And thank you so much for joining us. I'm really looking forward to the next 30 minutes we have here. First of all, I want to start off with welcome, Shelley. Welcome, Cheryl. Thank you so much for joining us. I'll get into introductions, but I wanted to spend a little bit of time, kind of the task at hand that we have. We have 30 minutes carved out. And the purpose I wanted to just state out of the gates, it's not about forecasting. It's really about sharing insights that we're seeing in the market from our clients, and what we're seeing in regards of the decisions that are being made to navigate uncertainty. Quite frankly, leading through uncertainty is something that I'm sick and tired of hearing about. And I see pretty much every podcast, every single piece of thought leadership is about it. But we're going to use it for the sake of today. And today we're going to focus in on really managing interest rate risk. And I was thinking about, as I was preparing for today, and last night before I went to bed and this morning when I woke up, of course, the environment changed even more. And this is regarding our friends to the south and some decisions they've made about retaliatory tariffs against us, and specifically Section 338, which I looked at Shelley, and then she quickly made a Ferris Bueller's Day joke, because in Ferris Bueller, it was actually Section 338 that was referenced, and I believe,
well done.
And I believe the reference was that it did not turn out well. It was not a productive exercise. And I think no matter when we're talking, we're always going to be talking about uncertainty. But at BMO, Daryl White, our CEO, has done such an incredible job. Investor Day, I think about, he came out and he started right out of the gates being, we are a commercial bank. That's one of the crown jewels that we have. We're one of the largest commercial banks in North America. And with that comes a great privilege, but also a responsibility, because we're able to have all this access to data and information. And that's what today is really about. The task at hand is really starting the conversation, because I think this is actually a unique point in the environment. And we're going to go through that, where I see the market actually shifting. Decisions starting to be made. There was kind of paralysis and pause, but I've noticed this collective switch has turned and people are starting to make decisions. And I think the both of you, and again, thank you so much for being here, really help us, inform us when we make those decisions, whether providing us incredible data as our senior economist, or giving us access to the full toolbox of interest rate risk we're talking about today, but your entire team, whether if it's FX, commodities, metals, and beyond. So I'm really looking forward to the conversation today. Thank you again. And Cheryl, you gave me your title. I was not satisfied with your title, because I would say Managing Director with Global Markets, because I've always looked at you for the time we've worked together in front of clients, and really you asking a lot of thoughtful questions about their business and exploring ways to reduce the risk. So Cheryl, why don't we start with you, and tell us a little bit about yourself, what you do, and why should we listen to you on this topic?
Cheryl Ferguson. We got the name down. So what I do with my team, we are brought in as risk management specialists. Our official title is Global Markets Advisors to all of our commercial bankers across Canada. I have been doing this for well over 20 years. We talk to clients, very small private clients up to larger corporate clients, and even our private wealth clients as well, just to start a conversation about, my specialty would be interest rates, just for have a discussion about where clients' exposures are and how to manage those exposures, not necessarily selling a product, so to speak, but just thinking about financial risk in the company that the client or the customer may want to eliminate, kind of take off that type of exposure out of their business, because it can be managed. And I think that's just having that discussion with clients is is where we hope to add value.
Yeah, and I could kind of speak to that, like time and time again. You impress me. I could put you in front of any client, whether if it's advanced manufacturing, whether it's agriculture. You really find out how to kind of reduce the risk within their business, and you never have like a single solution. So thank you again for all the partnership. I know our clients really value it too. And Shelley, our senior economist, again, thank you so much for being here today. And you may get upset you didn't clear this, but it is also Shelley's birthday today. So happy birthday, and thank you for dedicating the time. Tell us a little bit about what you do, how you do it, and how we leverage you across the entirety of the commercial bank and the enterprise.
Sure. Thanks for having me. It's a pleasure to be here. I started at BMO 6 years ago, and if we're talking about uncertainty, think back to 6 years ago. That was the spring of 2020, of course, a whole other shock. But you mentioned my birthday, and we'll talk about that later off the air. But I'm a millennial and grew up, in the shadows of the tech boom and bust. And we had 9/11, we had the GFC, we had COVID, of course. There have been so many shocks. So it's just been so much change all the time. That's like the constant. And you mentioned Ferris Bueller, but the fact is he wasn't really paying attention in economics class. So that was one of the things that kind of led me to be an economist, was actually like taking these very abstract ideas that look very distant, but I would always see on the news and would always be affecting my day-to-day life, and kind of put that more into practice and more relatable to people. And that's one of my favorite parts of the job and what we do in the economics department too.
Yeah, well, we really appreciate it, because the size of BMO's research department is impressive, and I think actually leveraging it is about doing exactly what you said, is capturing the stuff that is thematic, that we could understand and actually turn into action. And I know simplifying that is incredibly valuable. For myself, my name is Stephen Jensen. I lead diversified industries within the Canadian Commercial Bank, and my job is really simple. I am here to kind of attract and support and develop the best bankers in the market to ensure that they're coordinating across the entirety of the enterprise around our clients, so that we're constantly adding value. It's pretty simple. So again, let's kick off the conversation, and maybe Shelley, I'm going to start with you, and we'll start with the big picture. If you had to summarize the current Canadian economic environment in 2 or 3 minutes, what are the most important things business leaders should be focused on?
Yeah, it's a lot to distill in 2 to 3 minutes, but I'll do my best.
And integrate the news from last night also.
I'll do my best. I think it's a relatively good picture here in Canada. Now, we are, of course, coming off of 2 straight quarters of contraction. We had a few months of questions of whether or not we're in a recession. Officially, for the record, we're not. But I think more importantly, it does look like momentum has started to pick up in Q2, and it does look like growth is starting to recover from those contractions. So that's, I would say, a very relatively good news story. It's not like we're booming, but muddling along given all of this uncertainty that we're dealing with. Of course, and that's through not just the trade war, but the Iran war. On the flip side, though, is also the fact that inflation has behaved very well. So I mentioned the war, and of course that drove up higher energy prices. But excluding those, that shock here, we've seen broader inflation stay relatively tame, right around the Bank of Canada's 2% target. Now, that is in part a consequence of the fact that businesses are finding it hard to pass along those higher costs to consumers, because, again, consumers are dealing with so much more of that uncertainty there. But again, relatively good news story. And so putting that growth picture and that inflation picture together, we have the Bank of Canada staying on hold. They've got rates at 2.25%. And it's at the point right now where they believe that they're providing some modest stimulus, but they do seem fairly comfortable staying on hold right now. And to your point about last night's news, I mean, there's always some sort of shock there, especially on the trade front and especially on the inflation front. And so that's providing, in our view, at least right now, at least some offsetting risks. So we've got that hit to growth from trade, and that would add some dovish argument there for the Bank of Canada, but also that ongoing concern of inflation spiking due to this ongoing energy price shock. And so putting those two together, at least right now, it does look like the bank is going to stay on hold.
I think you did that perfectly within 2 or 3 minutes. I think you captured it very eloquently. I find this incredibly fascinating right now because I don't know about you. I have the Globe and Mail, I have the Wall Street Journal, I have the Economist, and if you're reading those every morning and every night, I feel like my hair's on fire. Like it's just like it could be a little overwhelming. But that's why I think this conversation is so important, because as you talk about the backdrop, it's actually fairly constructive. It's not overheating. And the reason why this conversation is particularly important is I've noticed this theme over the last 12 months that, quite frankly, just a lack of, like, the business community is recognizing they will not have certainty. They will not have clarity, whether if it's capital to place, investment, capital expansion. They're starting to move. They're starting to move and recognize, hey, I'm not going to get certainty. Therefore, I need to start placing bets and actually moving forward. The backdrop is fairly constructive. Do I have that right, Shelley? It definitely feels like that now in my conversations with my clients.
Yeah, I would say so. I think there's some element of maybe the economy, businesses regaining some footing. What we have seen so far, at least in the survey data and talking to some clients, is there's some element of acknowledging that, this is the new normal. We can't react to every headline. Even we just saw last night, the market reaction was fairly muted, and that's a whole different world than what we were in a year ago. So yeah, I think there is some element of, you can only control what you can control. And I'd be interested to hear if you've heard similar things like that as well. But it does sound like there's some element, again, it's just a new normal. Can't overreact to every single headline that you see out there.
I think we're just fatigued with the headlines as we move forward. But I think the market is better understanding that we can't say, oh, the world has changed every single day, or else we'll be in paralysis. Over the next 6 to 12 months, Shelley, what are you really focused on? What are you looking at as kind of cues of what's going to unfold next? And where would you direct our audience to be focused on for data or information or details that are unfolding?
Yeah, so I mentioned the Bank of Canada does seem quite comfortable staying at 2.25%. If we look at our interest rate forecast, we do have the overnight rate staying there at least through the rest of this year, and for now into next year as well. I would caution against, just saying, okay, everything's hunky-dory, we're all stable. There's a lot of risk underlying that forecast. So we've got them on hold, but again, some of the things we're watching for, of course, is what happens with the war, what happens with energy prices. Not just, when does the war end, but how quickly does it take for global oil inventories, energy inventories to come back. And that will help kind of deliver the breadth and the persistence of this inflation shock. That's what the Bank of Canada is going to be watching for, especially any hawks on the governing council. But then on the flip side, again, how is this trade war going to play out? We have this additional uncertainty on the future of the USMCA. What happens with all of these tariffs? Even yesterday's announcements, they're not expected to come into play for another 30 days, which gives us a little bit more time to negotiate and a little bit more uncertainty on exactly what is going to happen in August. So I think those two aspects are what the bank is watching quite closely. But also, I also want to highlight U.S. growth does remain quite resilient and does continue to surprise on the upside. And that is one of the major drivers still, despite all of this diversification effort, that is driving economic growth here in Canada as well. So that's also something that we're watching quite closely.
If it's not up, I'll ask the team to put up the most recent forecast, BMO forecast. And ultimately what I'm looking at here is that flat line of 2.25%. But what I found really interesting in the conversation as we were laddering up today's conversation was forecast across all the banks are different. And Cheryl, I think you captured it really well, that with so much volatility, it's really hard to do a forecast right now.
Yeah.
Right? And it kind of seeing this flat line in regards of a forecast and where it's staying, it can create a false comfort if you aren't educated behind the scenes. Excellent. Thank you so much, Shelley. I really appreciate it. I'm gonna pivot the conversation to yourself, Cheryl, and maybe we'll move from the data, from economics, and go directly into the application. And with the current backdrop that we've just outlined, what's sophisticated management teams doing today to manage risk, manage interest rate risk, and beyond? What are you seeing in the market?
And I think you both touched on it a fair bit, saying, there's so much headline news. Yes, you feel the Bank of Canada is going to be pretty steady state, but there's all these other outlying events that everyone is watching quite closely. So, it really comes down to, there's so much to think about out there. And I think what we're seeing a lot of our, small and larger corporates are doing is they're saying, okay, this is the new normal, a lot of uncertainty. How can we manage through this? A lot are actually putting in place formal hedge policies. So, not all of, the exposure or the risk is on, the CFO to make decisions on foreign exchange hedging or interest rate hedging. They have a policy in their company that says we will manage risk, interest rate and foreign exchange risk, as an example, or commodity risk, to hedge 50% of our exposure and manage that on an ongoing basis. That's just an example. And I talk about this a lot. So then you're removing all of these events because you're keeping within the frame rate. Everyone in the company has decided that this is how we're going to proceed. By not hedging 100%, you're still leaving yourself some flexibility if interest rates go lower, or if the exchange rate improves in your to your advantage. But I think that just puts a framework around, here we have some stability on our balance sheet. And then, so this is what the company's decided. We can weather through all of these events that may be coming on the horizon, so to speak.
There's two themes I'll pick up there because I've seen it so continuing to increase in the market, and that's the optionality. So often I think people are sitting back and they're like, I do not know if the forecast is going to change, if there's going to be another triggering event. So I need to understand. I think there was a time and place, quite frankly, I don't want to use the word complacency, but a little bit of complacency and laziness where they'd stand back from interest rate or FX and beyond and say, oh, at the end of the year, it's a wash. I don't like, it's either this way or that way. It either helps me or hurts me. In this environment, it seems like we can't afford to do that. And that's where I'm noticing a lot of moves. The other thing that I just want to highlight, and this is such an important point, is coming up with a framework and a process before that event happens, right? Like that, because if you're in the middle of it, you aren't going to be as well equipped. That's very apt. Thank you. So I'm going to move the conversation to kind of a misconception that I hear often from leaders when they hear hedging, and many assume hedging 100% of their interest rate or their FX exposure. How should you actually think about risk management when you think about the whole capital stack or FX exposure? You could go into commodity and beyond. How do you think about it?
Totally agree that, 100% hedge, there is a time and place for that. If you want to match the term of your asset with the term of the liability. But usually we see most clients hedging somewhere, as I said, between 50 and 70% of their total exposure, specifically on the interest rate side, because businesses change. You don't want to be always, locked into a particular interest rate. Plus, markets are constantly changing. As I said, you want to take advantage if interest rates are dipping and you have variable rate exposure, you want to, average down your total cost of borrowing. So there is that flexibility in there as well. And that's why we always say, we're not going to recommend that you hedge 100% of your total debt that's outstanding.
Yeah. Well, what I love is when we're in that conversation with a client or a prospect and we're going through exploring ideas to help them, what I really appreciate is when you'll start actually, you can talk about FX, you can talk about interest rate risk, but you actually start asking about what is their margin? What is their cash flow? Understanding their inputs, their supply chain. And the person kind of sits back and says, oh, I thought you were an interest rate specialist. Right. But what I love is that you're capturing materiality. because there's going to be a business and a capital structure out there that needs to hedge 100% of their interest rate risk, and that's because their top line is fixed and margin is fixed. And there'll be another one that could actually afford a little bit of wiggle room. And I think that's the critical place, is the business first. And also the other piece, which I think is so important, is the risk tolerance of the business owner.
It's huge.
Right. And I think we've seen that time and time again when there has been a triggering event and we realize someone is very stressed out and they're having a sleepless night, and we have to really move quickly to kind of come up with a strategy. I'm going to go back to Shelley's slide. I know it sometimes irritates you, and it's and again, looking at it, and it's holding at 2.25%.
Yeah.
How should we interpret that? And how do you interpret that as a subject matter expert who's worked through interest rates? Where does the confusion sometimes come in?
Yeah, you know what? The typical confusion is bank holds interest rates steady. What sometimes certain individuals forget is that that's a short-term interest rate. And that's not a that's a clear indication of, the time right now and the health of the economy, so to speak. But when we look at the shape of the yield curve, so where are 5 and 10-year bonds, where are they trading at this particular juncture? What that yield curve is telling you is what is the future health of the Canadian economy. So when we have an upward sloping yield curve, that's going to tell you, what interest rates, in this particular environment, interest rates may increase over time. Fair assessment?
Yeah, I would say so.
Madame Economist. And, just if clients are only looking at that short-term interest rate today, then they might not be thinking about, the future. Okay, well, if they wait to lock in a fixed rate, when the bank starts increasing short-term interest rates, long-term interest rates may have already moved by that point, because they do move ahead of central bank moves. So that's just educating clients on, monetary policy and, how the bank, the overnight rate trades versus how 5 and 10-year interest rates may look somewhere down the line. And it's just kind of balancing that. And that's another reason why clients may look to hedge 50% today, because this is how the interest rate market looks today. Okay, let's wait 3 months. They might want to do a little bit more, because then you have a better sense of what the economy is looking like. And that's where we're seeing that's how clients are, executing on hedges today. They're not doing all of their hedge today. They'll say, okay, I'll do a little bit today. We'll see how the environment looks, because we know it's going to be different in 30 to 60 days. And, just getting a sense that way. And, what is the outlook for the Bank of Canada going forward? But again, it's just that, separating that short-term interest rate, and sure, that's flatlined. But what is happening on that 5 and 10-year? And I think Shelley probably gives us a better scope of the...
I would ask the team to put up the slide that you bring to really highlight this. Yeah. And you'll see this slide that goes from 2006 to current day. And the punchline for me is there's always going to be triggering events. Yeah. And it's actually at those moments of perceived stability is the time to evaluate your hedging strategy and deep into those conversations before that triggering event happens.
There's might be too late.
There's, as I look at it, there's some really scary moments here. But the other thing that's really interesting is there's some incredible opportunity when you look at this slide about when you should be having those conversations. And I think about kind of the forecast that we have coming out of our firm right now, and how it kind of portrays an important moment in time where we could really have solutions proactively created for whatever is in front of us.
And this is something that my team, that we do. We can provide this, be a partner to your commercial banker. We can talk to you about, here's where we are in the current environment. These are kind of things, because Shelley can't have conversations with every commercial client across Canada. But here are certain things that we can do, or here's the environment today. Here's some solutions that you might want to think about. Just having those conversations early. We don't necessarily need to see a deal today. Like, oh, yes, there's a loan, there's a financing coming up. It's having those conversations and being equipped with knowing what's out there and managing those exposures, I think is the big thing.
I know today's task at hand is around interest rate risk, but I wouldn't mind shifting the conversation to you, Shelley, and just maybe touching a little bit on the FX market, specifically USD CAD and the volatility. A lot of our clients are North American in nature. And what are you seeing right now? What information are you looking at really closely for FX volatility in front of us? I shouldn't say volatility.
Well, yeah, I think coming out of the pandemic, we're in this era of, persistently weak CAD, persistently strong USD. So I would say the risk is really tilted towards a potential reversion. So, if the USD kind of loses a little bit more steam, at least more meaningfully than what we've seen in recently past episodes, I think that would potentially point to some of that. How that could happen, we're looking at US data in particular, inflation, but also the growth side to see if, there's potentially some signs of a slowdown or at least some sort of, cooling off in economic growth. On the flip side for CAD, there's all these questions still on the trade front. And I think we really need some sort of clarity on USMCA in particular to get that long-term stability to really help support the loonie, at least over the medium term.
Yeah. Thank you.
Can I ask you some questions?
Sure, go ahead, please.
So what, from a banking perspective, you're talking to a lot of clients across Canada. How do you think they're managing their risk?
Yeah, I would say it's definitely switched from, hey, let's have a conversation to we need to address this. We need to address this right now. Last night is a great example. I framed the conversation that I've noticed this theme throughout the market where clients are starting to move, whether investing in expansion, acquisition, or beyond. And they say, okay, we're never going to get clarity, but we can't stay still forever. But in the absence of that clarity, I better have a rock solid strategy. And you've seen this, you and I have been in the room where we're exploring all the ways. And this is what I appreciate about the big team behind you, Cheryl, is that there's a link, whether if we're talking about interest rate risk to FX risk, to commodity and metals and beyond, all the different ways that you could actually reduce the risk on the transaction. So that's a common theme happening right now. And the number one question you and I always get is, what is smart money doing? Whether if it's a $10 million debt load on a company or a $500 million debt load on the company, there's actually a pretty similar parallel to the conversation, depending on the industry, because there is a different story for different industries out there. Yeah, excellent. I'm just noticing right now, we're already at 12:29 my time, and we're running out of time. Thank you so much for being here. I really appreciate it. We will share this material out to our entire audience, and we'll also share some of our most up-to-date economics research and a lot of the collateral that you provide us. So we'll send that out to the audience. But I think the most important takeaway is engage your BMO relationship manager, and they are plugged right in and can coordinate the entire team around here. As one of the largest commercial banks in North America, it's a privilege to have you as our clients, and with that comes great responsibility. And that responsibility is make sure we're exploring all the ways that we can help. So thank you for the partnership, and looking forward to continuing the conversation. Take care.